So we were at these great levels back at the end of last year, whether it was pandemic related or not. We had that horrific sell-off in the first half, and then predictions for a retest of those lows during half of June and most of July. We had that really sharp snapback. What was that about? Was that about setting up a move to lower lows? Or this pullback right now is just sort of shaking out the 50% retracement from the initial sell? I mean, that was a pretty good rally. Was that just a complete head fake that's going to take us lower? Or are they trying to keep people out of the market right now that eventually is headed higher?
Yes, good morning, Joe, and thank you for having me on this morning. So you're right. It really was a pretty good rally that we saw over this months. But, you know, investors have been watching the same data. They've been listening to the same speeches, and they've been drawing different conclusions. And of course, that's what makes a market. And the conclusion that investors were drawing over the summer is that the Fed would pivot and start cutting rates next year. But we think that especially after Powell's speech at Jackson Hole, that he reiterated that the Fed is on a mission to lower inflation, and that means lowering demand, and that means paying for the economy. So we believe that there's a recession in our future, and that we're probably headed lower here, not higher.
What do you think, Kevin?
Yeah, Joe, unfortunately, I have to agree. You know, we're looking at quantitative tightening entering the picture this month. And as aggressive and hawkish as Chairman Powell has been and the Fed has been, raising rates is something that we don't necessarily see the effects of, sometimes for 6 to 9 months. But quantitative tightening, if you take $95 billion of liquidity out of this fixed income market each month, we've already seen it with rates going higher as a result of it. And that's like a rate hike. So when we have the Fed meeting in September, whether we do 50 basis points or 75 basis points, it may be an issue of semantics, because I think they want to get at least another point into this system. Quick back of a napkin math said that might get us somewhere around 3.5% Fed funds rate. So we're not done. And markets, Joe, you and I are old enough to remember some Septembers and Octobers in the past. Markets are not done seeing their fair share of volatility.
Well, you talked about, you know, what the Fed's duty is. Will that be effective? There's so many different, Kevin, there's so many different reasons for inflation. Is just cooling an economy, which, you know, we're running hot. There's a lot of money sloshing around, but, you know, we're not growing at 6%. It's nothing like that GDP-wise. It was a good economy, but so just taking that economy as it is and saying, all right, we got to definitely induce a slowdown, perhaps even a recession, because we're going to cure inflation. With all these varied and sundry reasons for which have gone into this latest inflationary spell, is that the way to cure it? Or are you cutting off your nose to spite your face?
Well, you hit the nail on the head, Joe. It's almost like you're forcing a recession. Like the Fed just knows that that's the path we're heading down. And so many folks come on the network and say, well, it'll be a mild recession. Recessions stink, even if it's a mild recession. So their toolbox is somewhat limited. They have to be aggressive in raising rates. Should they have started earlier? Sure. But, you know, that's hindsight's 20/20. The QT is going to help. And another thing that can really help inflation is this strong dollar. I don't know if we think about that in this whole macro picture, but the strong dollar will help.
I'm not seeing it right. Maybe it's a beggar thy neighbor, but we certainly are the best house in terms of the neighborhood. We've got to go, Tracie. Just some final thoughts.
Sure. So you're right about the U.S. being the best place in the global economy right now. And that's where we are positioning investors. It's U.S. over international, and then up in quality within the asset group. So large caps, mid caps over small, and within fixed income, move away from high yield toward investment grade.